Hello and welcome to Get Started in the Market. I'm Manvi Dhillon. On this show, over the last 4 weeks, we've shared tools and insights to help you become a confident, assured, ready stock market investor. If you've missed any of these episodes or you'd like to run through some concepts again, just log on to ndtv.com and you'll find all the episodes right there. We're at the point in the series where you know how to buy or sell stocks and shares in the market. The mechanics, the paperwork, all the do's and don'ts. But there's still a very important chapter that we need to address. What stocks to buy or sell? And that's what we're going to address this week and the next on Get Started in the Market. If you read business newspapers and magazines or watch the financial news on television, you've probably come across the terms fundamental stock analysis and technical stock analysis. So what do these terms really mean? Fundamental analysis of a stock, actually a company, is a method of evaluating various factors and parameters that could impact a business and its future growth. It includes the financial position of the company, the quality of its management, industry prospects, and even the health of the economy, all of which could individually or jointly affect a company's performance. On the other hand, technical analysis focuses on analyzing the stock and not its business. Broadly speaking, it is a method of forecasting future stock price movements based on a detailed study of past price movements. Technical analysis uses a wide variety of charts that show price movements over time and anticipate what is likely to happen to prices over time based on that trend. Valuing companies is not a piece of cake, but it's also not as complicated as it sounds. Let's get started with a few financial ratios that help us evaluate the relative strengths and weaknesses of companies. One of the first things you should focus on is the earnings performance of a company. How has the company delivered on earnings over the past few years, and what are the earnings expectations over the next few years? You can measure a company's profitability by looking at its earnings per share or EPS. EPS is calculated by taking the profit and simply dividing it by the number of outstanding shares in the market. For example, if Tasty Ice Creams Company has generated a profit of 100 crore rupees and has 10 crore outstanding shares, the earnings per share of this company will be 10. Now let's take this example forward and use the EPS metric to compare two companies. Say another ice cream company, Yummy Tummy, has generated 200 crore rupees as profit and has 50 crore outstanding shares. The earnings per share of Yummy Tummy will be just 4. So the point to note is that though the profits of Yummy Tummy are double that of Tasty Ice Creams, yet Tasty Ice Creams is seen as a stronger company based on its earnings per share. So the higher the EPS, the better the stock is perceived. But it's only fair to compare the EPS of companies in the same sector. Another financial ratio commonly used to judge a stock is price to earnings, or the PE ratio. This ratio tells you the price the market is willing to pay for the company's earnings capability. It is calculated by dividing the price of the stock with its earnings per share. Let's extend the example we just used. Let's assume that the price of a stock of Tasty Ice Creams and Yummy Tummy is 500 rupees. Now we need to compare the PE ratio of these companies. Here's what you do. Divide each company's stock price, which is 500 rupees, with each company's EPS and you get the PE ratio. So the PE ratio for Tasty Ice Creams is 50 and Yummy Tummy is 125. This basically means that for every 10 rupees of earnings, the market is willing to pay 50 rupees in the case of Tasty Ice Creams. And for every 4 rupees of Yummy Tummy's earnings, the market is willing to pay 125 rupees. A higher PE ratio usually indicates that the investors are expecting higher earnings in the future. But a stock with a lower PE ratio and higher earnings visibility is considered a better investment.
Basically, it will definitely vary from sector to sector. It depends on the return ratios which any particular sector can generate. It depends on the market share which a company has in that particular sector. The kind of cash flow generation, what is happening, the kind of brand that particular company has built. For example, B2B companies will have a lower PE multiples, while P2C companies like Asian Paints or Hindustan Lever, they'll have definitely have a higher PE multiples. Plus the track record of rewarding shareholders. That is also very important. And finally, the most important thing is earning growth. So these are some of the factors which will play out in terms of identifying what kind of PE you should pay for a particular company. It is a question of a track record, a trust a shareholder has developed on the company, and of course the earning growth. So sometimes it happens that a smaller company gets a higher PE multiple because the earning growth is very high. So it depends on that also.
Price to book is another financial ratio that is used extensively for fundamental analysis. To understand how this ratio is calculated, let's first understand the meaning of book value. Book value is the total value of a company's assets that the shareholders would theoretically receive if a company were to close down. And if you divide the total book value with the total number of outstanding shares in the market, it would give you book value per share. If this value is closer to the current market price of a stock, it suggests that the stock is underpriced according to this parameter. If you divide the current market price with the book value per share, you get the price to book value, or the PB ratio. If the ratio is below 1, the stock would be a value investment.
The banking stocks typically gets valued on price to book because essentially we look at the ROEs of the business. And when we look at the kind of the ROEs that some of these banks deliver, which is the return on equity, in that context the price to book is very, very essential, because for every bank I think one of the most important thing is the kind of the net worth that they're carrying, because it's essentially the bank businesses are highly leveraged businesses, or any financial services for that matter. They are highly leveraged businesses. They typically lend 8-9 times of the net worth. So and most of the profits typically get reinvested in the business. So I think the kind of the net worth growth that the bank has had in the last few years actually tells you where how the bank has done well. From that perspective, price to book or market cap to net worth becomes an important ratio to look at.
Debt is often perceived as a negative word in our personal lives. But debt isn't always a bad thing, especially when it comes to companies and economies. Companies need to take on loans and debt to finance their businesses, especially companies that operate in capital-intensive sectors like infrastructure and auto. But that doesn't mean a company should over-leverage itself, or in simple words, take on more debt than it can afford to pay off from the returns it expects from the investments. So, businesses balance the use of debt and equity to keep the average cost of capital at a minimum. We can assess if a company is using its debt smartly by its debt to equity ratio. This is done by dividing a company's total liabilities by its total equity. A debt to equity ratio of around 1 will mean that its liabilities equal equity.
Debt equity ratio is a very fundamental ratio. I think it defines the leverage for any company across the sectors. Actually, the debt equity ratio has to be seen relative to the sector, because we have got large capital intensive sectors like infrastructure, cement, steel, capital goods. So here normally we see the debt equity in proportion of say 1:5 or 1:1. Typically, whenever the debt equity ratio goes beyond a particular level, that is the time when we see cash flows getting impacted. And many companies, to just give you an example, companies like Jaiprakash or Bhushan Steel, clearly they were sectors which required capital not only from equity but also from debt. So obviously debt equity is a requirement which is a must, but it has to be within limits. I think if you look at cash rich companies, it's the exact opposite. They possibly generate a lot of cash from their internal operations. So there the debt equity doesn't arise at all. But otherwise debt equity for an analyst is very important. It should be more or less be maintained and sustained at a particular level. Any sharp increase in the short term can be considered, but if it continues to increase at a longer pace over a longer period of time, then definitely it's not a good sign.
The last financial ratio that we will focus on is return on equity, also called ROE. This ratio measures the company's profitability by showing how much profit a company generates with the money shareholders have invested, and is calculated by dividing the net income of a company with its total shareholder equity and is expressed in percentage terms. The higher the return on equity, the better it is. Companies with a high return on equity are perceived as efficient.
Return on equity is a very important financial metrics that is there for any investor. It reflects the net income of a company as a percentage of shareholders' equity. ROE can be different based on industry. It can be based on what kind of inflation levels that are there, what kind of macroeconomic factors that are there. But in stable economies, you generally see a 10 to 12% ROE that is there for companies. In higher growth economies, you see significantly higher ROEs coming in. And higher the ROE, the better it is for a company or for an investor in terms of financial metrics that is there. The important thing is it should not come out of significant financial leverage. You can have a higher ROE coming out of higher financial leverage as well. But that's not something that's necessarily good for the company. So when the company has a reasonably balanced debt equity ratio, the higher the ROE, it is better. In India, you've seen significantly high ROEs for a lot of industries, for a lot of companies, and that should clearly be considered as as an important financial metrics while deciding on investing in a company.
The popular wisdom is that novice investors should focus on the fundamentals of a company before investing in a stock and leave the technical route to more seasoned market traders who have a short-term trading horizon. At a time like this, advice from the legendary Warren Buffett bears repeating. Warren Buffett's advice is, view a stock as part ownership of a business. But how do you put such advice into practice? Find out after the break.